I'm Peter Rose, along with Currency Trading. Today I wanted to chat a little bit about risk management. And, most of the discussions about risk revolve around the classic risk to reward or reward to risk ratio. But managing the risk is different than just establishing a ratio. And risk management, or the process of risk management, is really dependent on whether you're a long-term trader or whether you're a short-term trader or a speculator, as I am. The differences in how you manage your risk are radically different based on what type of trader you are. For example, in a long-term approach where you might be looking at profit targets of 200 or 300 pips, and therefore your risk is 100 or 200 pips, you're establishing that based on the structure that the price is offering you and the distance that the potential it has to travel. The factor that concerns me as a scalper in looking at that type of thing is those sorts of profit targets and their associated risk levels have to be distributed out over days, if not weeks. That's a long time to be exposed to a risk. If I get into my car, for example, and I'm going to drive down to the grocery store, which is 5 miles away, and I don't wear my seatbelt, I'm taking a risk, but I'm exacerbating that risk, or the probability that risk is going to be hit, or some part of it, over a long period of time, a 3-mile drive or a 5-mile drive. It's a little bit different than if I was simply pulling my car without a seatbelt, pulling my car out of its parking spot in the driveway and pulling it out onto the street so that I could maybe snow blow the driveway or something like that. If you happen to be in an area where there's snow, you got to do that. So the risk of being hit is the risk, but your exposure to that risk increases the probability of that risk occurring. And it also has more to do with the intensity of the risk. In driving the car, pulling the car out and driving it, your risk driving from your house 5 miles down to get groceries or something. I mean, you could get a flat tire, you could get rammed by another car, you could hit a pedestrian. So there's all sorts of risks and levels of risk other than just saying, well, I'm taking a risk in driving down to the grocery store. What's your risk in backing your car out of the parking area in your driveway and putting it on the street so that you can blow snow? Those are much easier to manage risks in the standpoint that I can look at the street, it's all full of snow, I'm going to back out, there's nobody around, there's nothing that's going to happen. I might back the car into a snowbank or whatever and get stuck, but I mean, in the big picture of things that are damaging to me or my vehicle or to somebody else, they're relatively minor when you're looking at that shorter risk period, and the level of risk that you're going to perhaps encounter as opposed to the longer term risk. So therefore you might say, well, look, I'm taking a 200 pip risk, but I have a 600 pip profit target. Well, how long do you think it's going to take you to get to 600 pips of profit? What's the probability that you're going to get 600 pips of profit, or even 500 or 400 pips of profit before that turns around and goes down 60, 80, 100 pips, 150 pips, or all the way to your 200 pip hit? There's so much time involved that your risk is distributed over a long period of time. So not only does the probability of your risk go up, but the intensity, the end result of that risk is magnified. The longer that I wait for, if the price is going against me, for example, in that 200 to 600 example, the longer that I wait while that price goes against me, it goes against me 10 pips, it goes against me 20 pips, it goes against me 60 pips, it goes against 80, 100. I'm in there 4 days, and the thing is 120 pips against me. It hasn't hit my 200 pip target, so, I'm okay. But on a one lot, that's a $1,200. That's a $1,200 hit that you would take if you closed out at that 120 point. What are you going to do? You're going to wait another 80 pips to get to your $2,000 risk. Or you're trading a one lot, and you're taking a $2,000 risk on a one lot where all you've got. I mean, U.S. Currency regulations, you can't even go into a trade unless you have 5% down. So if $100,000 priced currency, you've got to have $5,000 of your $10,000 for your one lot just in your margin. Now, once you have the trade established, sure, you can run 20 to 1 or 50 to 1 on your balance. But the point of the fact is that if you lose that $2,000 or $3,000 or $4,000 and your margin is 5, I mean, how many times are you going to be able to take that trade? What happens, like happened to me when I was trading big time and I was over leveraged and learning this stuff, I lost 6 big trades in a row. I was trading 6 full lots, for cripe's sakes, and it cost me, I think it was $15,000. And I lost those 6, and so, like a dumbass, I didn't reduce my leverage, and I kind of screwed around with it. I won a few times. I was a big hero. Then I lost a few more times, and it was just a toilet flush after that. So my position as a short-term trader, as a scalper, I want to be flat at the end of the day. So a trade for me might go for an hour. If I'm trading on the 5-minute chart, I've got 12 5-minute decisions an hour whether I want to get into a trade, and then if I'm in the trade, whether I'm going to get out or not. And my stop is a mental stop. It's going to be an 8-pip stop or an 8-pip stop loss with the spread. You might get another pip and a half. So you might go. You might have to set your stop 10 pips out in order to get the actual 8 of your of the spread that you want that price to be able to move before you tap out. Because if you have an 8-pip stop, you're going to get stopped out at 6 3/4, 7 pip, something like that. You're going to get stopped out earlier because of the VIG, the spread. But regardless of that, I'm going to find out about that loss real quick, and I'd much rather do that and say, I was wrong on my setup. I'm going to go get another cup of coffee. Speaking of coffee, and I'll come back later, 15, 20 minutes, and see if that setup has improved. If, on the other hand, price doesn't go down 4 or 5 or 8 pips and take me out, and it starts to head up, I've established some parameters of what my profit target from a structural standpoint is potential. I'm not expecting to get that whole potential of structure because those structure boundaries, as you all know, can be spread. You can have a resistance line, for example, at 1.250, and you're going to have to take 5 or 8 pips on either side of that line as a band because nothing is static. Those resistance are zones or areas because they're based on people putting limit orders for stops or purchases if you're going long. So there's order collections at that point that create, from an economic standpoint, those support and resistance areas. In any event, knowing that I've got this zone or this band, I will not take a trade unless there's at least 20 or 25 pips of structure given it to me. If it goes in my favor, 5 pips, good. I'm going to move I'll move my mental stop up. I don't use stop orders. I don't put limit orders in scalping. I don't want to encumber my brain with making additional decisions. I want to be able to have my finger on the trigger to be able to fire off right away, whether it's a go in hit the bid or whether I'm gonna yank myself out of a trade. I don't want a limit order there. If I have a stop limit order and the thing is gradually approaching that line, I'm going, oh man, I'm 6 pips out, I'm 7 pips out, I don't want to wait. Even a more dramatic example is at a profit target at let's say 20 pips, and I'm at 17, and I've got my stop set at 20 pips, and this thing starts to stall. I don't want to be thinking, oh, it'll make it my 20 pips. It'll get there. It ain't going to get there. Son of a bitch is going to turn around and flatline on me. You know that as well as I do. So why put a stop on it? If you're a long-term trader, you got to put stops on there because you can't sit and watch the screen all night. So you got to put stops in there. And so the big boys, the institutional traders, the hedge funds, and all those guys that are level two aware, they know where all those stops are. Why do you think that when a certain market zone opens for trading for the day, it's in the middle of the night? Like if I'm at Eastern time, I trade pound dollar. So at 3:30, 2:30, somewhere in there in the morning, depending on our time frame, the London market is opening. And if you're not up watching that and you're a long-term trader, that thing can move 60 pips against you. I mean, there's whole trading systems that are based on the London Open. You're going to get whacked as you approach those zones. But if you're a long-term trader, that risk is built into the reward over the long term. As a short-term trader, I don't want those limit orders on my screen. I don't want to be encumbered by that. I want to be able to look at that price action and say, nah, this is running out of gas here, which is a subject of volatility, and I could probably do another video on that at some point. But regardless of that, I want to be sitting there watching this price action and say, man, this just isn't going to make it to that 20 pips. I'm at 17 pips. I'm at 15 pips. I'm just out. Boom. I'm going to go out. That's it. So those determinations that I've been discussing have to do with risk management. Risk management ultimately boils down to where are you going to get out? Not why, but where are you going to get out? And there's 4 methods of risk management and determining what your stop out level is, whether you're going to be doing a limit order or whether you're going to be sitting there with your finger on the button and ready to go out. Anyway, you can put your stop loss, or you can base your stop loss on a dollar amount, on a percentage of your bank, some indicator like a fast moving average crossing along, or you can deal with it on price action itself. I'm not a fan of the dollar amount because that's confusing for your brain. I could say, well, I'm going to take $100 risk on this trade. I'm trading a 1 lot. I'm going to take $100 risk. It's 1%. Well, all of a sudden, then I stage in another lot to my trade. Now I'm dropping that potential risk by 50% because I've staged in. And so the $100 doesn't represent the same distance of travel that I had before. So now I got to change the way that I think. I just don't get that. I think that makes the trading decision process from a risk management standpoint more difficult than it needs to be. I just think using the dollar values are crummy. If you know you're going to be staging in 3 lots and you want your risk to be overall, let's say $100 or say 60 pips, whatever that is, figure out what that is on a per lot basis and then manage it on a pip basis, which is more of what I'm going to do, what I do. The percentage of your bank is another way that you can set your risk management. You know, the rule is 1% to 2%. Some people risk up 0.5%. Those folks are trading six-figure accounts. They're not trading. The average retail trader account is probably about $3,000. And even a larger trader trading $100,000 account, 10 lots, or I don't know, $60,000, $50,000 account, 4 or 5 lots. You at that point your risk is different. If you have a $50,000 account, you can trade $10,000, $15,000 and make $200 a day without any problem. The poor guy that's trading a $3,000 account, he's trading 3 minis, and he's going to risk 2% or 0.5% of that on a trade. He could sneeze and blow himself out of the trade. You know, it just doesn't make any sense. So, yeah, if you have a big account and you're trading long term, then maybe a percentage of your thing. But again, you're looking at, I've got $40,000 in my bank, so 2% of that is blah, 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 blah. And now, okay, I've lost 3 trades, and now my account is down to $34,000. And so now my risk is 2% of that. And so you're doing all these mental gymnastics of calculations as to where to put your. That's just ridiculous as far as I'm concerned. That makes the trading difficult. You're going to wear yourself out, and you're not going to make the right decisions by doing that. You can do it by technical indicators. You can sit there and you can wait for that fast MA to cross the slow MA. I mean, those don't work anyway, because every technical indicator is based on past information, and there's a time lag in past information. I can go into I've written chapters and chapters in my some of the books that I've written, all unpublished, by the way. I don't have anything to sell, but it's only for my own education. But talking about the problems of technical indicators. If I have a currency trading student, for example, I take 4 of those indicators and I say, okay, now I want you to trade a sim account, and I want you to track your trades, and I want you to religiously do this. If it's a fast MA over slow, then when that happens, you got to take that trade, and you'll see the time lag involved in where the price is in relationship to where the cross happens, and it doesn't work. If you're doing a computer simulation, which I've done thousands of simulations, I've run simulations that have 1 million reps on them, and I've done all the statistics on that. And the computer can pick those points right as they happen and lock it in, and you can make that computer work. I've had the computer simulation stuff do moving average crossover stuff and be very, very successful in trending as well as chop markets for the most part, because it's so fast. It's right there. But when you're sitting there trying to make these decisions in real time, I will guarantee you 100% that's not going to happen. If you trade, if you manage your risk on placing stops based on technical indicators, you're going to fail. Now, you can base it on price action as well, which is okay from a certain standpoint. But again, the problem is the decision process. Here's the scenario that happens. I'm sure this has happened to you. It happens to me all the time. I'm looking at a trade and it's going against me, and I say, oh, well, it's Tuesday and the Federal Reserve isn't going to up interest rates anymore, so the price will continue to do blah, 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 blah. And it doesn't. It continues to go against me. And I lose more and I lose more. And pretty soon you get to the point where you go, well, maybe tomorrow. Maybe. Maybe this will come back tomorrow. It ain't going to come back tomorrow. You're done. You went out with the tide, brother. So, although it sounds encouraging as a price action trader that you're going to manage your risk through price action, there's too many decisions. My decision is really simple. The decision process in trading is all based on how do I get in? When do I get in? What do I do to get in? How do I do that? That's the decision process. Once that's done, you don't have to worry about anything else. Because if you're worried about getting out, well, you don't have a trading plan, as far as I'm concerned, particularly as a scalper. As a scalper, it's 8 pips. That's it. When it hits 8 pips, I'm out. When I follow that rule, if that's the only thing that I do in risk management is get out with 8 pips, I make a lot of money from a percentage standpoint of my bank. When I don't follow that rule, when I break that one simple rule of getting out at 8 pips, those mount up. And those mount up significantly in comparison to the average win that I'm looking for is 5 pips. Look, if I can make $5 1,000, that's 0.5%. And if I could do that 4 days a week, that's 2% a week. Hello? Now we're talking about some really significant gains. But if you don't follow, and my stuff that I do is based on mathematics that I've set up. I got a degree in physics. I've done a lot of math. I've done real estate investment for 40 years. Numbers. I understand numbers. I understand probability. I understand statistics. And I've worked through this stuff. And from a standpoint, you get out with 8 pips and be happy with a 5 win. And if I can do that, my win-to-loss ratio goes way up. And that allows me to make really, really good returns on a weekly or monthly basis. Yes, I do invert the risk-reward ratio if I'm doing a risk of 8 and I'm getting out at 5, but I don't do that all the time. Remember, I said my profit target is 20 away. I'm not expecting to get that 20 structure. I'm expecting to get maybe 13 of it. So if I can grab 2 13s and a few 5s, and I lose a couple of times at 8, I'm ahead. And anytime I'm ahead for the day more than 0.5% on my bank, that's big money. That's big money. And I'm not real sure that if you're a long-term trader that you're going to be able to do that, because if you make those just one error on a long-term trade and you move your stop or you wait or procrastinate from 100 pips to 150, 50 pips that's $500 a lot. Man, that's a lot of money. That's just a lot of money. Anyway, I hope that discussion on risk management has been helpful for you. Again, your risk management is going to be radically different from mine if you don't think like I do, and if you're not a short-term or short-term speculator. You're going to have to take all that stuff that I've said and map it over into the long-term stuff, because what I've said as a speculator is valid for the long term, because I became a millionaire in real estate, and that's a long-term trade. I know what I'm doing as far as risk management goes. So if you're a long-term trader, you just have to look at this stuff differently on a different time frame than I would look at it as a short-term speculator. Again, my name is Peter Rose, Longwood Currency Trading. I hope you have a great day and a great trading day.